Welcome back to another episode of CapitalCall. I'm your host Snigdha, and today I'm in conversation with Tarun Davda, Managing Director at Matrix Partners India. Matrix is one of the country's most well-known venture capital firms. Its portfolio includes startups such as Ola, Daily Hunt, Razorpay, M-Swipe, and many more. Tarun joins us today to take us through how Matrix is navigating the COVID-19 crisis. Hi Tarun, thanks for joining us. One big factor that's different about this downturn is that it's not cyclical. Nobody really knows how things will play out and within what time frame. So as an investor, how do you manage risk in that kind of scenario?
Stinta, great question. And again, thank you for having me. I think all of us are seeing something like this for the first time in our lifetimes. And so clearly a lot of what we are doing is just learning as we go, right? I don't think anyone really knows how things will exactly play out. I think there are people who have a more optimistic view of the world, and a lot of what they read and what they put out is over-indexing the optimistic part of what will play out. And then there are other people who have a pessimistic view of the world, and everything that they read, obviously they're over-indexing the pessimistic part. And so it's very hard to know exactly which way things will play out. So one is, no one knows. And so I think the first thing that we are doing ourselves and we are sort of telling founders to do is, don't keep your plans too sort of, cast in stone. You need to be flexible. You need to be nimble at this time. While there are a bunch of immediate actions that a lot of our portfolio companies have done, what we're telling them now is that, okay, this is great. You've done what was the immediate thing to do. But now you need to be a lot more nimble in terms of figuring out what the right sort of response should be, right? As more and more data comes available. I think the broad guidance to most of our companies has been, plan for what would likely be the worst case scenario. Okay. And the worst case scenario, depending on company, is very different, right? For travel and hospitality, it's very different. For an enterprise company, it's very different. But say for example, in a travel company, in some cases, people have said 3 to 6 months of zero revenue, another 3 to 6 months of 10 to 30% revenue, and then eventually maybe coming back to 60 to 80% of revenue 12 to 15 months out. Right. And so people have taken very, very conservative views of sort of what the world will look like a year down the line. In some companies, people have actually said zero-based revenue for the next 12 months. And am I still okay in that sort of scenario? And so, planning for the worst, and each company, like I said, the definition of worst could vary depending on the sector they're in. And the reality is, companies never imagined this, right? In many, many companies, some of our largest companies, some of the largest companies in the country, revenues have gone to zero overnight. Right now, these are very large companies with large cost structures, large fixed costs, 3,000, 5,000, 10,000 employees. It's very hard to ever imagine and plan for a situation where your revenues went to zero overnight. And suddenly you're finding your fixed cost structure like completely untenable, right? And so I think one is, it's taken investors' time and it's taken founders' time to accept this reality that, listen, my revenue is zero, and what does that mean for my business? And if it's likely to stay at zero, and now all of us have accepted this reality that it's going to be zero at least for 1 month, could it potentially be zero for another 1 month? Who knows? But likely it will be close to zero in many sectors for another few months. And so I think one is, our advice to founders has been, if your revenue has gone to zero, your cost line item, you can't start at where it is today and then say, okay, what adjustments do I need to make for it? You have to start with a zero cost base as well and say, okay, to support a zero revenue, if I was, an early stage company, what kind of cost structure would I have? Now, that's where you start. You may not end up there because it may not be practical in many places. But if you start over there and you start thinking about, okay, every single cost item that I'm adding, hopefully you reach a scenario where you have sufficient runway to sort of tide through this crisis, right? At least our guidance to all our companies has been, you need to have 24 months of runway. And so we're basically telling people, listen, if we're in mid early to mid 2020, you need to find a way to stay, to survive for at least 2 years, which is, sometime mid-2022. Now, it doesn't always happen. It's a few months here and there in some cases. Now, fortunately, a lot of companies, given last year was a bull run in both private markets and public markets, a lot of companies have raised capital in the last 6 to 9 months. And so those companies, I think, are fine. There's unfortunately a few companies that weren't able to raise last year or didn't plan to raise last year and they were planning to raise early this year. I think for those companies, they are the most vulnerable right now. Right. And so that's where we're spending most of our time in sort of helping them sort of figure out what needs to be done. And I think the last, thing, there was this very good blog post that one of the US VCs had written, which is, are you default alive or default dead? Right. And I think that question today has become even more important. And I think founders are asking themselves this question. Investors are sort of, working with founders to figure out, like, listen, is this company default dead or is it default alive?
Has the way you work on a day-to-day basis changed a lot?
So, I was thinking about this and, at some level, honestly, the days haven't changed a lot. I used to spend maybe 40-50% of my time on portfolio companies. Admittedly now it's higher. And so maybe it's now 70% of my time on portfolio companies and, lesser time on evaluating new opportunities. But what has definitely changed is the nature of conversations have changed, right? I think if I zoom out, this, I think sometime around early to mid-March, it really hit us that, this is going to be a once-in-a-lifetime event that is completely going to reset the way you sort of think about the world and think about your portfolio and think about sort of opportunities. And so I think the first 3 or 4 weeks were just spent with every single founder understanding how they have been impacted and how is the sector likely to get impacted. And like I said, as there was more data that was, getting available to all of us, that understanding was getting refined with every sort of interaction. What we did is very early on, we actually created a, typical 2x2, which said on impact and on runway, which segment do you fall on, right? So if you're in a sector which has been highly negatively impacted by COVID and you have low runway, you are the most vulnerable. Right. And so there was a lot of priorities in just making sure that those companies are able to land safely. And we'll talk about some of the things that are happening over there. Obviously, if you're in the enviable position of having a positive impact and enough runway, I mean, the discussions are very, very different, which is, how do we accelerate? How do we make use of this? And you're seeing a lot of ed tech companies, a lot of media companies, a bunch of grocery tech companies are starting to see that. And so I think depending on that, where you land, I think there is a very different nature of conversations that we are having, right? So that's one thing that we started doing. I think the second is just working very closely with the founders and figuring out what should be the response to ensure that the company is surviving. And I think at every conversation, it starts with an emotional response, right? Like, listen, I've hired these people. I just sold this big dream. This person took a huge pay cut to come join me. How can I ask them to take a pay cut again? In some cases, hey, you know what? I've already rolled out all these offers to sort of, new freshers or B-school students that were joining. How can I delay the joining date? Stuff like that, right? And so it starts with an emotional response. And but while none of us like that harsh reality, the first thing is the founder and the CEO's job, and the board of directors' job is to protect the company in any eventuality. And so I think that involves obviously difficult discussions, and some people take longer to get to that answer. Some people get to that answer very quickly, but you almost always reach that answer in most cases. I think as in once we figured out, okay, here is what which quadrant the company lies in. I think there was a series of immediate actions that were taken. And obviously, in most cases, revenue is completely out of our control, given what's happening. But what is in our control is the cost side of things. And so there has been, everything from figuring out how do you reduce your payroll costs, how do you reduce your office rental costs, how do you reduce your sort of, debt repayments, or how do you sort of restructure them. In many cases, companies cut marketing budgets down to zero overnight because, if people aren't able to buy, they aren't able to go out and, react to your advertisements. What are you going to do, right? And so I think there was a lot that was done first to say, okay, first let's get the cost structure in order, because all the other analysis and all the other problem solving and brainstorming you can do if you're alive. If you're dead, it's all pointless, right? And so I think my sense is the first 3 to 4 weeks were spent almost every day, morning to night. All the sort of funds have several companies that they work very closely with. And so those were the first series of discussions, which is, okay, let's first stabilize the company. Let's make sure that you have, 2 years of runway or more if you can. I think very quickly then the discussions started moving to what I call phase 2, which is your product relevant in a post-COVID world, right? So if you're a travel company, now within travel, are you business travel? Are you leisure travel? Okay. Within that, are you international focused? Or are you sort of domestic focused? And, again, people have reached different conclusions, which is, hey, business travel is likely to rebound much faster than leisure. And within leisure, domestic is likely to rebound much faster than international, right? And so we've actually gone down to that level, obviously, and much deeper to figure out that, okay, within each vertical, within each sort of, consumer sort of use case, are you likely to be positively impacted once things start resuming? Or are you continuing to be sort of in a sort of, unknown zone or unclear in terms of when things will recover? Like I'll tell you in mobility, right? For example, now it's likely that shared mobility will be much more negatively impacted for a longer period of time. For the simple reason that, people will likely want to maintain social distancing. So for example, and all of us see this in our cities, right? In buses, you have people like falling over each other, hanging out of the buses. Now, is that going to continue? Unlikely, right? People will likely just sort of avoid those kind of things. Second is, there's a lot of bike taxis, for example. Now, would I or would you, it's a question for both of us, right? Would you be comfortable sitting on a stranger's bike and knowing that stranger has ferried 10 other passengers that day, right? It's unclear how quickly that will recover. But is there a personal mobility option where I am getting a sanitized bike offering and I can sit on that bike and maybe I have gloves that I use so that I know that I'm not touching something that anyone else has touched that, right? And so again, and obviously that's at a lower price point because everyone knows that it's a tough time economically for, a very large percent of the population. And so, will people just want to spend less because they have less money in their wallets, right? And so depending on each of these, what we basically quickly started getting into the phase 2, which was, okay, how relevant is your product in a post-COVID world? And if it's not as relevant, what should you be doing today so that you can, pivot to something that is going to be more relevant? Can you alter your product offering? Can you tweak your messaging to your customers? In many cases, what can you do to make sure that your customers will trust your brand and trust that you are a safe option for them to use in a post-COVID world, right? And so I think that was phase 2, in a post-COVID world where it is. And I think now phase 3, very quickly, I'll touch upon that. We've just, like maybe it's been a week or so since we're in that phase now, is actually now working with portfolio founders to say, okay, now that you've secured the company, now that you have some sense of your product and whether it's relevant in a post-COVID world, very quickly people are starting to look for opportunity in this crisis, right? And so internally, what people are calling it is the offence strategy, which is, okay, once lockdown ends, the other, and one of our founders used this line, which I thought was great. And he said, what, this is the first time that everyone's market share has been reset to 0, right? Yeah. So no matter how big you were before lockdown, no matter how small I was, the reality is we're now starting the race at point 0. What can I do to take advantage of that and basically, get on an offense strategy? And if I have capital, if I have a product that is still relevant, there is no reason why I should continue to accept that reality where you were, maybe 5 times my size or 2 times my size. I can, technically we're all starting at 0, right? And so a lot of people are now starting to look for that sort of offense strategy and say, what should I be doing so that I can come out a winner from this?
What about the firm's own runway? I know you still have a fairly large corpus in reserve, but what's going to be the strategy to deploy it over the next, let's say, 6 to 12 months?
Yeah. So I think, the good thing is that we are backed by very long-term investors who invest, they've seen, several of these market cycles. This is not like the first time that they're seeing a shock. I think, most of our investors would have gone through multiple shocks to the economy. And so I think from that perspective, we're actually very fortunate that we're backed by investors who haven't taken a 1-fund view or a 3-fund view or a 2-fund view. They've literally taken multi-decade view into investing into it, right? And investing into the partnership. So I think in that sense, we're obviously very fortunate. We also raised our last fund, which is the current fund that we're investing out of. This was done in the second half of 2018, right? And so we've basically been deploying for the last year and a half from this fund. And so, we actually have enough runway, enough dry powder. We continue to invest. I've heard several investors say, what, I'm going to just get out of the market for the next 3 months. I actually think that's probably a bad idea. All of us have heard and seen, and in our own experience, some of the best investments are available to you at this time, right? You find founders that are betting their lives at probably the most uncertain times in history. They clearly have a lot of conviction in what they're doing. They're not starting up because raising money is easy. They know it's going to be extremely hard, and yet they've got enough courage of conviction to do that. So we continue to be active in the market. We actually signed 2 term sheets last week, and these are for fresh new investments into companies. And I can't obviously share too much, but I can tell you a little bit about sort of what stage those companies are and why we were comfortable doing it. But we continue to do that. Will the deal place slow down? I think it absolutely will. Most investors I talk to are spending a large part of their day just managing portfolio and managing portfolio situations. I think most investors are just unable. It may not be unwilling, but most investors are just unable to get comfort on backing a completely new team that they haven't met or just on a video call. Right now, would at some stage people start doing that? Depending on how long this lasts, I think it may happen. And obviously, it may not be as frequent as what one would like, but I think people are already starting to do some of those things. And I think the third, and this is a more practical difficulty, is especially during lockdown. There are companies which are sort of slightly more, late stage companies like Series B, Series C, Series D companies. I mean, and where you're writing a large check, right? You're writing a $10, $20, $30 million check or whatever it is. It's very, very hard for you to build confidence and build comfort without doing on-ground diligence. So typically when an investor invests, you do a lot of supplier checks, you visit the warehouses, you talk to the on-ground teams, you do, speak to, vendors and, all sorts of stuff, right? You just practically cannot do that, given where we are today. So my sense is that early stage investments, which is seed investments, will continue. I think the larger checks will definitely slow down, right? But remember, there will also likely be a faster rebound there, because there will be a lot of investors sitting on the sidelines, waiting for the lockdown to end, who have been eyeing these quality companies for a while, and now those quality companies are actually available at much better valuations than they were 2 or 3 months ago, right? It's the same rebound we've seen in the public markets. Now, people may have different views on whether that rebound is sort of completely unfounded, but the reality is there has been a rebound, because that's exactly what investors have done. They've said, what, these are the top 10, 20 quality sort of publicly listed companies. I've never seen these available at a 30, 40, 50% discount. And so people are just buying it, saying, what, it's okay, over the next year I may look stupid, but over the next 5 to 10 years I will look very smart. Right? And I think the same sentiment may play out in private markets as well, with all the quality companies. The other thing that I expect is that people will be comfortable writing checks to sort of known founders. So talking about the 2 sort of investments we made, both of these are very early investments. These are sort of pre-revenue companies, more at like product stage or pre-sort of product stage also in some cases. These are founders that we've known, we've tracked since a while, we're comfortable with them. And so even though we couldn't meet them for this specific interaction, the fact that we've known them earlier, we could do video calls with them now, understand what their plans. Obviously, it's just an easier decision to take, right? And because it's not a company that is already doing a lot of stuff on the ground, there wasn't a lot of diligence that we needed. Essentially, it's really just doing market diligence, which I can very well do sort of, sitting at home on a laptop, right? So it's involved secondary research, it's involved, conversations with industry experts, etc. It's not required, thankfully, a lot of on-ground diligence.
Despite the downturn, we are still seeing deals getting done. Now, there's obviously a lot of talk and grief about down rounds, flat rounds, inside rounds, and so on. Matrix itself has just made a couple of investments, follow-on investments in existing portfolio companies. What kind of conversations do you end up having with founders when you go in to negotiate deal terms in this environment?
So we've had some of those conversations. Just, one thing I will correct. At our end, we announced Itilite last week, which was led by Greenox and VY Capital. It's actually in the travel space. The term sheet was signed well before COVID. Kudos to the investor coming in. I mean, they've shown really high, conviction. Those are the kind of investors you want long term, on your cap table, right? And so I think the second one that we announced was gaming investment called Zupi. This has also been in the works for a while. So I think all the recent announcements, I would say these were all deals done pre-COVID, right? And in most cases, I think, like I said, all classy investors have continued to stand by the commitment to invest, and in most cases at the same valuations, right? Which has actually been great to see. In some cases where either the investor is not a long-term India investor and, don't do as many deals in India or don't do as many deals, period. And where they had come in very hot and heavy, given large prices, large check sizes, I think all those deals are basically being discussed, right? And this is not like specific to Matrix portfolio, just I'm saying in general in terms of what we are looking at. And so there have been cases that we've seen where, somebody's come in and said, hey, this made sense sort of pre-COVID, but your own plans of what the next 2 years look like have completely changed. And obviously your valuation is as much about where you are today, but it's much more about where you expect to get 2, 3, 4 years from now, right? And so I think in some of those, it's just fair game to say, hey, listen, if the world is going to look very different, I think, it does make sense for us to renegotiate on that. Right? In the worst cases, we've seen investors just disappear, right? They've just literally, disappeared overnight and say, we're stopping on investing. Sorry, guys, but, let's pause and reconnect in a few months. I think what we have seen, Snigdha, in terms of internal rounds, I think there are two varieties that we've seen. One is where the company is actually not as badly impacted. It's a quality company. They expect to do well post-COVID. Their business model hasn't been, completely sort of impacted. And unfortunately, it was one of those companies that were looking to raise money sometime this year, right? There, I think what we are seeing is internal investors are saying, hey, this is a great company. We're actually very excited. We thought they were going to, raise a round with an external investor coming in and pricing it sometime this year. That's unlikely to happen for all the reasons I mentioned. And investors are saying, hey, there's 2, 3 of us on the cap table. Why don't we put together a smaller round and maybe at a lower valuation than we thought the company would raise? And founders are very happy to take that because for them, what they're optimizing for is getting money in the bank, like I said, and making sure the company is alive and it comes out stronger from this crisis, right? And because your internal rounds, you're also getting these at much lower dilutions than you would see in sort of larger rounds that you take from an outside. So I think that is one conversation that is happening, and we're seeing that in some of our companies, right? Where unfortunately they weren't in the market like ways and stuff like that. The second one is where it's the company is what I call in the vulnerable zone, which is it's highly impacted by COVID. The sector is completely sort of destroyed, if I may use the term. And the company also has less runway. I think those are the hardest conversations, and those are the ones that are taking a lot of time because every incremental dollar that you're putting in, I mean, as an investor, you have a responsibility towards the company, but you also have a responsibility towards your own investors. Yeah. And so every incremental dollar that you're putting in, you need to be able to justify ROI on that, right? And so I think those are the more difficult conversations. They take much longer. It takes a lot of time to align with the other investors on the cap table because everybody has a very different worldview. And then obviously it takes time to convince the founder that, listen, a flat round is not a bad thing. It's actually a great thing in this environment. I mean, if all public market stocks in your sector are corrected between 30% to 70%, there is no reason why, you should hold on to your valuation as well. And so, flat round is the new up round, and a down round is not such a bad thing to have, right? And so I think in my mind, these things matter less in the long term. Would you end up diluting a few percentage points more in your company? Sure, right? And that's unfortunately the reality of it, right? It's eventually it's a demand supply game. If there's more demand for your stock, then you have more leverage and you can price it at any price. But if there isn't enough demand and the only people that are willing to invest in your company are people who are already insiders, you should take advantage of just having somebody who can still put in the money and just take money at whatever price is available. And obviously you have to balance that out with, is this a good long-term partner to have? right? And so I think it's important to say that, you know what, I'm taking money and this person I don't believe is a long-term partner for me. I think that's very different from saying, hey, you know what, I know these are high-quality investors. There's a person I want on the journey with me for the next 5 years. It's okay if they can't give me the best price that I wanted. And so I think those are some of the conversations that we are happening. And like I said, our advice to founders, again, going back to what I said first, just focus on survival and take money at whatever best terms that are available.
Thanks, Tarun. Great chatting with you as always. You've been listening to Capital Call with Tarun Davda from Matrix Partners. Stay tuned for the next episode at TechCircle.in. Have a good day.